This reading is about return concepts. Here we will start out by talking about the different kinds of return. So for example, there might be a holding period return, there might be a required return over a given period, there might be an expected return. At the end of a period, we might calculate the realized return. So I hope you recognize that there are many different kinds of return, and the type of return that we are talking about depends on the situation. Over here, we'll understand these different types of return that we talk about. Then we'll move on to the equity risk premium. The idea here is that investing in equity involves taking on more risk compared to, say, investing in government bonds. That extra risk means that we demand an extra return, and that extra return is the equity risk premium. We'll then talk about the capital asset pricing model, which is one of the simplest asset pricing models, and this involves beta, which is a measure of systematic risk, and it also involves the equity risk premium. We'll then talk about multi-factor models for equity return. So rather than just relying on one factor, which is the equity risk premium, and the beta, which is the sensitivity of a given asset to the risk premium, we will also talk about other factors that can impact an asset price. And the final segment of this reading is about the weighted average cost of capital. Basic return concepts such as holding period return, realized and expected holding period return, and so on. Let's start with the concept of holding period return. Holding period return is the return earned from investing in an asset over a specified period of time. This is the holding period. It could be 3 months, 6 months. Essentially, it is the period for which you are holding on to an investment. The formula for the holding period return is quite straightforward. I will explain this through an example. Let's say that you buy a stock for $50, and at the end of the holding period, the stock price is 58, plus you receive a dividend of 2. The holding period return then is DH, which stands for the dividend received over the holding period, which is 2, plus the price of the stock at the end of the holding period, which is 58 in our example, divided by P0, that's the original price of the stock, minus 1. When you do the calculation, you will have 60 over 50 minus 1, that is 0.2 or 20%. Another way to look at this formula is shown right here, where we can say that the holding period return is the dividend yield, which is, in our example, 2 over 50, plus the capital gain, which is 58 minus 50 over 50. So this would be 8 over 50. And this will also give us 20%. If the dividend and the holding period price are realized, then we call R the realized return. And this is fairly straightforward. Let's say that you are sitting here at this point in time, say this is 30th June, and you made your investment on 1st January. This is the holding period. You made the investment here on 1st January, and then you sold your stock for 58 here, plus you got your $2 dividend. Then the return of 20% would be called a realized return. On the other hand, if you are sitting here at time 0 and over the next 6 months, which is your next holding period, you expect a certain dividend called DH and you expect a certain capital gain, then the yield that you expect over this holding period will be referred to as the expected holding period return. Coming now to the concept of required return. The required return is the minimum level of expected return that an investor requires given the asset's riskiness. The required return represents the opportunity cost for investing in the asset, i.e. the highest level of expected return available elsewhere from investments of similar risk. If the expected return for a given investment is greater than the required return, then we say that the asset is undervalued. Take a simple example where, based on your calculations and expectations, over a given holding period, the expected return is 12%, but the required return is 10%, then we say that the asset is undervalued. On the other hand, if the expected return is 8% versus a required return of 10%, then the asset is overvalued. If the expected return and the required return are the same, then we say that the asset is fairly valued. In an efficient market, the expected return and the required return will be the same. The expected or ex ante alpha is the expected return minus the required return. And clearly this is a looking forward number. In other words, you are here at time 0 and over a given holding period, let's say that you are expecting a return of 12%. The required return for assets of similar risk over this period is 10%. Then we can say that our expected alpha is 2%. The realized or the expected ex post alpha is the actual holding period return minus the contemporaneous required return. Let's say that over this period, the actual return, now you have moved forward in time, so you are at this point, and the return that you actually realized was 8%. During this same time, the contemporaneous required return was 5%. So the question is, what do we mean by contemporaneous required return? This is an important term that keeps showing up in questions. The contemporaneous return is the return on other investments with similar risk during the same period. So if you invested in a particular kind of stock, you look at the return on other similar stocks, similar risk over the same time period. And this return, let's say, is 5%. And remember, this would be a realized return associated with similar stocks. The realized ex post alpha then is 8% minus 5%, which is 3%. And when investment managers are measured, when we look at their performance, we look at the realized or ex post alpha. So this is a measure of the manager's investment skill. Expected returns from intrinsic value estimates. Let's say that a stock is undervalued, and here we will connect with material from a previous reading. Let's say you have a situation where the market price of a given stock is 60 and you believe that the intrinsic value is 70. Now, you plan to hold the stock for a year. What are the different scenarios? One scenario is that this mispricing increases. In other words, you continue to believe that the value is 70, but the stock price falls. So the market price actually goes down. So this mispricing will actually increase. Another scenario is that over your holding period, the mispricing stays the same. Third scenario is that the mispricing may partially correct. So here the mispricing is 10, maybe the mispricing goes down to 4. Mispricing may be corrected completely. In other words, this mispricing of 10 goes away, which will be good for you if you actually purchased the stock at 60. And finally, the mispricing may overcorrect. When you buy an underpriced stock, then your expected rate of return has two components. One component is the required return, and this will be calculated typically based on a model such as CAPM, where the return will be based on the risk characteristics of the investment. The other component of return is based on convergence, and convergence here refers to the convergence between the market price and the intrinsic value. In other words, over time, the market price will hopefully converge to what the intrinsic value should be, plus there will be the required return. So in other words, the expected return is RT, where RT is the required return given the level of risk, plus this expression which refers to the convergence between the value and the market price. Let's look at this through an example. We are talking about Procter & Gamble shares where the required return is 7.6%. And if we are not told otherwise, we assume that this rate is an annual rate. At this time, the market price was 63.16 and a research report estimated the intrinsic value at 71. If the price converges in 1 year, what would be the investor's holding period return? So this is fairly straightforward. Here is the formula we use. Expected return is the required return plus convergence. This is quite straightforward. The required return is 7.6%, which is given. And then this convergence is 71 minus the current market price divided by the current market price. So the expected return is 20%. If the investor expects the mispricing to disappear in 9 months, what is the holding period return? Here, what we do is take the annual required return, 1.076, and then raise to the power of 9 over 12, because 7.6 is an annualized number. So we need to de-annualize this by raising it to the power of 9 over 12. This is the holding period, and then minus 1 to come up with the percentage. Then we add 12.4%, which is coming from the convergence, and this gives us 18.05%. Note that this 18.05% is for 9 months, whereas this 20% is for 12 months or 1 year. To compare these two numbers, you will have to take the 18.05 number and annualize it. And when you do that, you will notice that in annualized terms, this return is going to be higher. Here now is an example from the curriculum. It's example 1, and I want you to try this before you look at the solution. This is the solution to part 1. Over the holding period, the expected dividend is 0.42. The target price is 32. So here's what's going on. This is time 0. Here the stock price is 28.27. The target price at the end of the holding period is 32, plus the expected dividend over this period is 0.42. So the expected return is simply 32 plus 0.42 divided by 28.27 minus 1, and this is 0.147 or 14.7%. The second question is, what is a target price that is most consistent with Microsoft being fairly valued? Now, if Microsoft is fairly valued, then over this holding period, we should expect a 9.5% return. In other words, if we are starting at 28.27, then the return here should be 9.5%. But note that our gain is coming through capital gains as well as through a dividend. If we look at the dividend yield, that is 0.42 divided by 28.27. When you do the calculation, you will note that the dividend return is 1.36%. 9.5%, which means that the capital gain is 9.5% minus 1.5%, which is 8%. So this number 28.27 will increase at 8%. And when you do the calculation, you notice that the expected value at the end of the year, assuming Microsoft is fairly valued, is 30.53. Some students get confused between the Microsoft example that we looked at here and the Procter & Gamble example that we discussed later. The key difference between these two examples is that with Procter & Gamble at time t equal to 0, we are given the required return and we are given the price at time 0, plus we are also given the mispricing. So with Procter & Gamble starting at time 0, there is a certain required return plus there is a convergence, and we combine these two to figure out what the overall return will be over the holding period. In the Microsoft case, at time t equal to 0, we are given a price, and then we are told initially that there is mispricing, but we are not directly told what that mispricing is. Instead, what we are told is that there is a certain price at time 0, then there is an expected price of 32 at the end of the holding period, plus there is a dividend that will be received over this period. So in the Microsoft case, it is quite easy to find the expected return. It is simply based on the price appreciation and the dividend. Coming now to the discount rate and the IRR. The discount rate is a general term for any rate used in finding the present value of a future cash flow. Generally, the discount rate depends on the characteristics of the investment rather than on the characteristics of the purchaser. In other words, if the investment is risky, then we use a relatively high discount rate. If the investment is less risky, then we use a low discount rate. The IRR is the discount rate that equates the present value of the asset's future cash flows to the asset's price. You have learnt about IRR at level 1 in equity, in corporate finance, and in quant. But here's a quick refresher. If you invest 100 at time 0 and at the end of 1 year, let's say you recoup 120, then the IRR, which is the return on this project, is 20%. And you can notice that if you find the NPV of this project, you have minus 100 plus 120 over 1 plus R. And if you set this equal to 0, then the rate which makes this equation true, in other words, the rate which makes NPV equal to 0 is 20%. So the IRR is effectively the return on the project. If an asset is correctly valued, in other words, the market price is equal to intrinsic value, then the IRR or the return will be equal to the required return. If we use the simple Gordon growth model, then the value of a stock or the intrinsic value is the year ahead dividend divided by R minus G. And I'm sure you remember this. Let's say this is the intrinsic value, which is equal to the price of a stock in an efficient market. This is equal to D1 divided by R, which is the required return, minus the growth rate. This is the sustainable long-term growth rate. You can do a little bit of algebra and show that R is equal to D1 over the market price, which is P. And notice that in an efficient market, the V and the P are the same, plus the expected dividend growth rate. And this is the key point, which is that in an efficient market, the required return and IRR are the same. We now move to section 3, the equity risk premium. We talked about equity risk premium at level 1. It is the difference between the return on the market and the return on a risk-free asset. We did not get into any details at level 1, but we will get into details now. The equity risk premium is the incremental return that investors require for holding equities rather than a risk-free asset. So essentially, the required return on equity is the current expected risk-free rate plus the equity risk premium. If you take equity risk premium, then that is simply equal to the required return on equity minus the current expected risk-free return. Like required returns, the equity risk premium depends strictly on expectations for the future, because the investor's returns depend only on the investment's future cash flow. Before I go into the two broad approaches for estimating the equity risk premium, I just want to connect this with what you are familiar with. I'm sure you remember the capital asset pricing model, where we say that the required return on a given equity is equal to the risk-free rate plus the beta of a stock multiplied by the equity risk premium, which is given by the return on the market minus the risk-free rate. So this is our equity risk premium. Sometimes at level 1 you were given the equity risk premium and you plugged it here. At other times you were given the market return and the risk-free return and you took the difference. So now coming to the two approaches. One is the historical approach for coming up with this number, and very simplistically this will be based on historical market returns and historical bond market or government bond market returns. And then the other approach is a forward-looking approach. Let's start with historical estimates. According to this method, the equity risk premium is equal to the mean value of the difference between a broad-based equity market index return and government debt return over some selected period. It is just a subtraction. But notice that I have emphasized several points in here, and I'm going to just say why I have mentioned this. When we talk about mean return, the question is, what do we mean by mean? Is it a geometric mean, arithmetic mean, harmonic mean? Then we talk about a broad-based equity market index. So question is, which index? Then we talk about government debt. Which government debt? Short-term, long-term. Then we talk about a selected period. 3 months, 6 months, 10 years. What is an appropriate period? So notice that there are several issues that need to be addressed. Before we go into those issues, here is another general point. If investors do not make systematic errors in forming expectations, then over the long term, average returns should be an unbiased estimate of what investors expected. Now here is a critical point. If you recall the definition from the previous slide, when we talk about equity risk premium, this refers to a forward-looking premium. What we are expecting on equity minus what we are expecting on risk-free investments. But here we are discussing a historical method. So what we are essentially saying is that if historical numbers are unbiased, and if historical numbers are a fair depiction of what is going to happen, then this method works. All right. So now let's look at these items that are highlighted. One item is an appropriate time period. Generally, a longer time period is better than a shorter time period. If you are comparing equity returns with government bond returns, then does it make sense to just look at returns over the last 3 months? Probably not. It makes sense to use a longer period. So longer period is better. But if the period is too long, then there is a risk that the equity risk premium has permanently shifted to a different level. Now, this issue is an issue which we talked about in quantitative methods. do you remember the issue of non-stationary data? For this method to work, the data set needs to be stationary. If the equity risk premium is permanently shifting from, say, a 6% level to a 8% level, then that means that the data is non-stationary. So that would create a problem. If you use data over a very long period of time, then the chances of this non-stationary problem become higher. The other point is that the geometric mean is preferred over the arithmetic mean. The curriculum goes over a long explanation for why this is the case. And this, by the way, doesn't mean that everybody uses the geometric mean. Some people actually make a case that the arithmetic mean is better, but I'll make two key points here. One key point is that the CFA Institute, or at least this reading, proposes that the geometric mean is better. And the other key reason, or the other key point, has to do with the reason. The reason is that when you are doing valuation, you are typically looking over multiple periods. And when you are looking over multiple periods, or your horizon is multiple periods, and you are discounting back, remember, ultimately the equity risk premium is used to come up with the cost of equity, and then the cost of equity is used to discount. When you are using discounting, then given that we are talking about multiple periods, it makes more sense to use the geometric mean. If you recall from level 1, when we talk about time series returns, then the better method was the geometric mean method as opposed to arithmetic mean. So I know that that is not a comprehensive explanation, but it is good enough for the level that we are at. Next point had to do with whether to use short-term government debt or long-term government debt. In other words, should you use the T-bill rate? Let's say that the T-bill rate is 3%, and let's say that the longer-term government bond yield is 4%. When you do the subtraction, market return minus the risk-free return, which return do you use? You will find in textbooks both methods being discussed, but this particular reading prefers the long-term yield. The reason is that your equity investment is long-term. So practically speaking, it makes sense to match your baseline or your government yield. It makes sense to match that long-term return with an underlying government instrument that also is of a relatively long maturity. The final point on the slide is right here. Historical equity risk premiums may need to be adjusted for biases. Where can biases come from? Here are two examples. You can have a survivorship bias, and we are going to look at an example here, but very briefly, when you look at the equity returns, and let's say you are looking at equity returns at this point in time. So if you take an index, the stocks in the index at a given point in time are the stocks that have survived. And the stocks that haven't survived, have dropped off along the way. These stocks that dropped off probably were the stocks that did not perform well. So because of this survivorship bias, will the market return be overstated or understated? It will be overstated. So the equity risk premium will be overstated or understated? It will also be overstated. So this is a bias that might need to be corrected. The other bias is a string of unexpectedly positive or negative events over the measurement period. Let's say that our measurement period is 3 years, or let me pick 5 years because that is used quite often. And let us say that over the last 5 years, our economy has been in a slump. So over the last 5 years, equity returns have been lower than historical averages. Is that possible? It is. If that has happened, so we've had a string of unexpectedly bad years based on unexpectedly bad events, then what will that do to the market returns? The market returns will be biased downwards, so the equity risk premium will be biased downwards. Alright, here is a classic example, and I want you to read this, and we'll then go over the questions and emphasize the main points. So now that you have read this, let's look at the questions and the solutions. What factors would bias an unadjusted historical ERP estimate upwards? Given the case that we just talked about, one is survivorship bias. So backfilling returns from 1979 to 1985. The general point, as we discussed earlier, was that when we backfill, then we are only going back and adding stocks that exist. So when we add stocks that have survived, those are stocks that have relatively high returns compared to stocks that were removed from the index. So the historical estimates of market returns will be overstated, which means that the equity risk premium will also be overstated. Another is the suppression of rates before 1991. What does that do? Remember, this risk premium is the return on market minus the risk-free rates. If the risk-free rate was kept artificially low, then the equity risk premium would be overstated, assuming that the markets were also not artificially low, but just taking the fact that the risk-free rate was lower than what it should be and not saying anything about the market return, clearly that might also bias the equity risk premium upwards. Next question. What factors could bias an unadjusted historical ERP downwards? Failure to incorporate dividends in the series prior to 1997. If you do not incorporate dividends, then what does that do to the market return? The market return is then understated because you haven't included the impact of dividends. If the market return is understated and the risk-free rate, all else equal, and the risk-free rate is the same, then obviously the equity risk premium would be lower. State and explain two indications that the historical series is non-stationary. The different levels of interest rates before and after 1991. So clearly, if your interest rate is fundamentally changing, then the equity risk premium is going to fundamentally change to a different level. Does that mean your data is non-stationary? Yes, so that is one issue. And then higher stock market volatility before and after regulation. Again, going back to quant, another element that defines that data is non-stationary is the volatility. So if the volatility has changed, then that also means that your data is non-stationary. So what this points out is that even though using a relatively long time period is good, but you need to be careful about what's happening in that relatively long period. Ideally, the data should remain stationary during the period. Given that objective estimates of the extent of biases can be developed, so this was actually given in the question, that once you've identified the biases, you can estimate the impact of those biases. An adjusted historical estimate would be preferred. So you come up with the equity risk premium, and then you recognize that there are biases. You can also quantify the value of those biases, which is easier said than done, but in the exam world, let's say it is given. Then you make the adjustment and use the adjusted ERP, not the plain ERP that you calculate. So some of you might be wondering where that survivorship bias came from, so I'm just going to explain it. The index was created in 1986, and in 1986 the index had the 30 best companies. Then the returns were taken from 1979 onwards. So the point is this: if we had picked the 30 best companies in 1979 and taken them forward, then some of those might have dropped out. But what is happening here is we are starting in 1986 and taking 30 companies. So only the best survived, and then we are looking at the returns of the best. So clearly there is a survivorship bias, and the returns because of the survivorship bias will be overstated. Moving now to forward-looking estimates. Forward-looking estimates are theoretically more appropriate because they are based on expectations for economic and financial variables from the present going forward. Remember, we talked about equity risk premium being forward-looking. So it makes sense to take forward-looking estimates. Ex ante, or numbers that we anticipate, forward-looking numbers. So ex ante estimates are likely to be less subject to issues such as non-stationary data or other data biases relative to historical estimates. But there's a drawback. Forward-looking estimates are subject to other potential errors such as model-related errors or behavioral biases in forecasting. I hope this point is straightforward. When we talk about various models, are those models perfect? Obviously not. So there are issues with the models that we use. The information that we plug into the models, is that information perfect? That's also not perfect. So those are the issues with forward-looking models. There are three main approaches for forward-looking models. One is the Gordon growth model, which you are very familiar with, but which we will also review. Then we have macroeconomic model estimates and survey estimates. So let's start with the Gordon growth model, and I hope this should be easy for you. According to the Gordon growth model, the equity risk premium is the market dividend yield plus the long-term market earnings growth minus the long-term bond yield. This is based on the assumption that the dividend payout as a percentage of earnings shall remain constant and earnings shall also grow at a constant rate. So I'm going to connect this with what you are very familiar with. If you take the case of just one company, where we are saying that the earnings and the dividends will grow at a constant rate G, then what do we say is the required return? We say the required return is D1 over P naught plus G, right? Now, think about this. If you expand this to the overall economy or all the stocks, then what is D1 over P naught? That is simply the market dividend yield. What is G? This is the long-term earnings growth, and we are connecting the earnings growth with the dividend payout. So these two terms are exactly the same as what we have over here. But we are talking about the equity risk premium. What is the equity risk premium? It is the return on equity minus the risk-free rate. So that minus of the risk-free rate is happening right here. It is minus the long-term bond yield. So this is no different from what you've seen earlier, except it is being applied at the overall market level. Here is a simple example. If you have the dividend yield on the S&P given, this is your overall market, the earnings growth rate is 7% and the US government bond yield is 5%. What is the equity risk premium based on these numbers? It is straightforward, 1.9 plus 7 minus 5, which is 3.9%. We now come to macroeconomic model estimates. Macroeconomic models are based on the relationships between macroeconomic variables and the financial variables that impact equity valuation. The focus here is on supply side variables that fuel GDP growth. The bigger picture is that when the economy grows, then companies also become larger and their value often increases. And therefore, this approach is more useful for companies which represent a large share of the economy. One example of a macroeconomic model is the Ibbotson-Chen model, which you need to learn. Here is the formula for this model. The equity risk premium is 1 plus expected inflation multiplied by 1 plus the expected growth rate in earnings per share multiplied by 1 plus the expected growth in PE ratio, or the expected increase in PE ratio, and then minus 1. So in essence, this can be thought of as the appreciation in price. And then we add the expected income component. This would be dividend income plus any reinvestment income. And then since we are calculating an equity risk premium, we subtract the expected risk-free rate. Now let's illustrate this through an example. I want you to calculate the equity risk premium given the following data. You need to plug numbers into this equation and come up with the equity risk premium. So here is what you need to do. The expected inflation is 2.5%, which is 0.025. So you can say 1.025 multiplied by this, which is 1 point. The expected real EPS growth rate, and a proxy for that often is GDP growth. So this becomes 1.03 multiplied by 1 plus the expected growth in PE. In our example, that is 0. So we are assuming that the PE ratio is staying the same. So this is simply 1. And then from all this, since we are coming up with a rate, we are going to subtract 1. Then we add the expected income component. And as I said, this would be a combination of the dividend yield and then the reinvestment income. So this is 2.2%. And then we subtract the expected risk-free rate, which in our example is 0.05 or 5%. When we do the calculation, what we should get is this number, which is approximately 2.775%. CAPM should be extremely familiar. Your expected return is the risk-free rate plus beta, which represents the systematic risk of a stock, multiplied by the equity risk premium. There are several assumptions behind CAPM, which we've studied at level 1, but the major ones are that investors are risk averse and they make investment decisions based on mean return and variance. So for a given level of variance, which indicates risk, investors want to maximize return. Estimating beta for a public company. How do we come up with beta? We touched on this at level 1, but now that you have studied regression at level 2, we can go into a little more detail. The simplest estimate of beta results from an ordinary least squares regression of the return on the stock versus the return on the market. The return is often called an unadjusted or raw historical beta. So if you look at the curriculum, they actually show you a Bloomberg screen where the beta is calculated. So you run a regression. What is the x-axis? The x-axis would be the return on the market, and the y-axis would be the return on a given stock. Then you would have these various data points, and you would then draw the regression line, the best fit line. The slope of this line is beta. So beta gives you an indication of the sensitivity of your stock return or equity return to market returns. Now obviously the choice of the index is important. In most countries you will use the benchmark or the major index for that country. In the US it is typically the S&P 500. And then the length of data. So whether you look at data for the last 2 years, 3 years, 5 years, 10 years, the general industry convention is to use 5 years of data. So this is the equation that we have here. The return on a given stock is equal to alpha, which is the intercept, plus beta, which is the slope, times return on market, which is the x-axis. So the beta that you come up with here is called the unadjusted or raw beta. I've already mentioned that. So if that is the unadjusted or raw beta, then there must also be an adjusted beta. And before I go into this formula, I'll give you a quick explanation. In the long term, beta is considered a mean reverting variable. Betas for high risk stocks will be more than 1, but over time, one expects the beta to come down towards 1. Betas for low risk stocks will move up towards 1. So if we come up with a beta using a historical method, but all our work really needs to be looking forward. So we need to come up with a forward-looking beta. So we have to adjust the beta that we calculated using the historical method. The new beta that we come up with is called an adjusted beta. And here is the formula that you remember for unadjusted beta. It is 2/3 into the unadjusted beta multiplied by 1/3 into 1. So this is just a weighted average of the unadjusted beta calculated from the regression and 1, where we are putting 2/3 weight on the unadjusted beta and the 1/3 weight on 1. 2/3 and 1/3 are given. These are typically the numbers used. If you see somebody else making a claim that the weightage should be 0.75 and 0.25, those numbers will be given to you and you can use them. It's important though that these two numbers add up to 1. So let's look at an example. So example 3 in the curriculum gives you a raw beta of 1.175, and then in the regression there is a standard error, so that's also given. This is relatively low, which makes you feel comfortable with the regression. What is the adjusted beta using the Bloom method? The Bloom method is the 2/3, 1/3 technique that I just told you. So what do you do here? The adjusted beta is equal to 2/3 into the raw beta plus 1/3 into 1, and this should give you approximately 1.1. Then you estimate the required return on this particular stock using CAPM. How do you do that? Should you use the adjusted beta or the raw beta? Adjusted beta. Otherwise, what's the point of doing all this? Since your required return is a forward-looking number, you should use the adjusted or forward-looking beta. So that is also a fairly straightforward calculation. The required return will be equal to the risk-free rate plus 1.1 times whatever equity risk premium we have. Explain one fact from the Bloomberg screen as evidence that the beta has been estimated with accuracy. The quick response is that we have a relatively low standard error. Next, you can try example 4, and I'm going to make this straightforward. You are given the beta, you are given the equity risk premium, and you are given the risk-free rate for 3 different companies, and you are supposed to use CAPM to come up with the required return. And if you can't do this, then I would suggest that you drop your plans for taking the exam in June, because this is as simple as it gets. Risk-free rate plus beta into the equity risk premium which is given. Alright, now I want you to read example 5. This is also fairly straightforward, but there are a few items in here that I want to emphasize. So just read this. Now here one point is, you need to calculate the adjusted beta and required return. So the question is whether you use the 5-year beta or the 10-year beta. And as I mentioned earlier, the common industry practice is to use the 5-year beta. So you use 0.3, and then to do the adjustment, you do 2/3 into 0.3 plus 1/3 into 1, and what you will then get as your adjusted beta is 0.53. And then what is the required return? Using CAPM, you have a risk-free rate of 4.9%. Why do you do that? You have a choice between 3.9 and 4.9. Do you use the short-term T-bill or the long-term government bond? You use the longer-term rate. So when you use 4.9.53, and what is the equity risk premium? We are using 4.5. What you should get here is approximately 7.3%. Is the sell side analyst's estimate of 10% given right here? So 10% for Allegheny's cost of equity, most consistent with Allegheny shares having above average or below average systematic risk. So here is the solution. The analyst's estimates implies above average systematic risk. So analyst is saying 10%, but our calculation is actually giving us a lower number. This question also shows that if the beta were 1, then the required return would be 9.4%. But what is the analyst saying? Analyst is saying 10%, so he is saying that this is more risky than the market. Whereas our calculations indicate that the beta is less than 1, so it is less risky than the market. This point, estimating beta for thinly traded stocks and non-public companies, this is something that you've seen at level 1 in corporate finance. When you have a publicly traded company, then you can do a regression because market prices are available for the company. But what if market prices are not available? That happens either if the stock is publicly traded but very thinly traded, or if you have a non-publicly traded stock. Here is the process. First is you select a benchmark company or a group of comparables. Then you estimate the benchmark's beta. Then unlever the benchmark's beta. So clearly the benchmark might have some debt. So you look at what the beta for the comparable would be without debt. This at level 1 was called the asset beta or the project beta. Then you lever the beta to reflect the subject company's financial leverage. So the two big questions are, how do you unlever and then how do you lever? So in terms of unlevering, here is the formula. You take the comparable company. The unlevered beta is 1 over 1 plus debt to equity multiplied by the equity beta. Equity beta is the overall beta that is given with the debt, with the leverage. Is this the same as what you saw at level 1? It is quite similar. In level 1, actually, we also multiplied by 1 minus t. Wherever we have debt, we multiply by 1 minus t. Here we are using a simplified version where we are not worrying about tax rate. Why are they making this different? I'm not sure. I think already this formula is an approximation, so they are just removing the impact of taxes. Strictly speaking, this is what you work with at level 2. So what will this give you? This will give you the unlevered beta of the company that you are trying to evaluate. And then how do you come up with the subject company's beta? Then you lever up. So this is for the subject company, 1 plus the debt to equity ratio multiplied by the asset beta. Will the unlevered or asset beta be the same for the comparable and your company? Yes, if the benchmark or comparable is a good benchmark, and in the exam world you assume that is the case. So now try this question. So here is what you do. The benchmark or the comparable has a beta of 0.5. It's an unlevered company. There's no leverage. So the unlevered beta is the same as the given beta, which is 0.5. Then your target company is a private insurer. You need to figure out the beta for the private insurer. Private insurer has debt. So the levered beta is 0.5 into 1 plus debt to equity. So what is debt to equity? You are told that this is 20% funded by debt. So debt is 20, which means that equity must be 80. So what is the debt to equity ratio? 20 over 80. So this becomes 0.5 into 1 plus 20 over 80, which is 0.25. So your answer then becomes 0.625. Coming now to multi-factor models. So far we have primarily focused on single factor models such as CAPM. But when we run regressions and we look at empirical evidence, then we realize that CAPM describes risk incompletely. The R squared, which is one of the numbers that gets reported when you do a regression, is generally in the 2 to 40% range. So it is often relatively low, which means that there are other factors or multiple factors which drive returns, not just equity risk premium and beta. So when we talk about multi-factor models, we are saying that the required return is the risk-free rate plus several different risk premiums. And what do we mean by a risk premium? This first risk premium, it is a product of a factor sensitivity and factor risk premium. We are now going to look at a few different multi-factor models. The Fema-French model, Pastor-Stambo, and macroeconomic multi-factor models. And if you pay close attention, you will realize that these are, in a way, extensions of CAPM, especially Fema-French. And let me explain why I say this. In the CAPM world, what do? You say the required return on a given stock is equal to the risk-free rate plus the beta of the stock relative to the market multiplied by the equity risk premium, which is the return on the market minus the risk-free rate. So if you were to just take this part of the multi-factor model or this part of the Fema-French model, don't you just have CAPM? You do. Look at the definition of RMRF. It is the return on market minus the risk-free rate, which is effectively the equity risk premium. But the Fema-French model says that your return also depends on other variables. What are those other variables? It is the size of a company and the book value relative to market value. And what do we mean by that? If you recall from level 1, one of the anomalies that you studied was that in the past it seems like small company stocks outperform large company stocks. So if we take that fact, then we need to adjust our model to reflect the size of a company. So this SMB stands for small minus big. This is the average return on 3 small cap portfolios minus the average return on 3 large cap portfolios. So if you believe the fact that small cap returns are higher than large cap, will this be a positive number or a negative number, the SMB? It will be a positive number. This will be a given positive number for a given economy. So if we are talking about the US stock market, SMB will be some number. Just like RM minus RF is some number. So in the US context, RM minus RF might be say 5%. And then SMB might be a given number such as 2%. Then what about the beta? The beta is stock specific. Just like this beta is stock specific. It is based on the sensitivity of a given stock's returns to the market. Similarly, this second sensitivity of beta is stock specific. Will this beta number be high or low for a relatively small stock? For a relatively small stock, the beta is going to be positive. Why? Because for a relatively small stock, you are expecting a higher return, or you are requiring a higher return. So beta is actually going to be positive. This beta size is going to be positive for a small stock. For an average size stock, beta is going to be 0. And for a large stock, beta is going to be negative. What about high minus low? Again, one of the anomalies that we have talked about is companies that have a high book to market ratio versus low book to market ratio will have different returns. So studies have shown that value stocks tend to do better, which means what? So companies with high book to market, are these companies that are good value? The answer is yes. High book to market means value stocks. So this HML, high minus low, is the average return on 2 high book to market portfolios minus the average return on 2 low book to market portfolios. A company that has average book to market ratio, that will have a beta of 0. a company with a high book to market ratio is a company that will have a relatively high beta value. So now let's make sure you get this. First we will do a simple example 7 in the curriculum, then we'll check your understanding. So estimate Microsoft's cost of equity using two models. So this is CAPM and this is the FEMA French model. What is the required return using CAPM? It is simply the risk-free rate, which is 4.7%, plus the beta. Which beta is this if we are talking about CAPM? This is the sensitivity of the Microsoft stock to the overall market. So 1.04 multiplied by the market or equity risk premium of 5.5. So this is fairly straightforward. What about model B, which is FEMA French? Do you start with a risk-free rate? Yes. Then this beta or the sensitivity is 1.14 multiplied by 5.5. So it would be plus 1.14 into 5.5 plus what? Plus the size beta. What does a minus size beta mean? It means that Microsoft is much bigger than average. So then it would be minus 0.22 into the SMB. This is a standard number for the US market, 2.7. And then the value, which is minus 0.328 into 4.3. So when you do the calculations, so over here, you will get the required return for Microsoft using the FEMA French model. Alright, on the same example, we need to critique a couple of statements. The first one, Microsoft's cost of equity benefits from the company's above average market capitalization, which offsets the stock's above average premium for market risk. What does this mean? Does Microsoft benefit from the company's above average market capitalization? Here we are talking about a very important concept. When we talk about Microsoft's cost of equity benefiting, what does benefiting to Microsoft mean? A high cost of equity or low cost of equity? From a Microsoft perspective, it means low cost of equity. Is this the same as the required return for investors? Actually, it is. It's just the flip side of the coin. So the cost to Microsoft is actually what investors return. Since the market capitalization is high, the sensitivity is negative, and that brings the cost of equity down. So this statement is actually true. The next statement, if our economic units analysis is correct, growth-oriented portfolios are expected to outperform value-oriented portfolios over the next year. So this is a short-term forecast. As a consequence, we should favor the CAPM required return estimate over the FEMA French model. This statement does not make sense because our models are based on a long-term view, and just because you have a particular short-term view, that doesn't make one model better than the other. The formal explanation is available here. We now come to the Pastor-Stambo model. This is a variant of the FEMA French model. And as you see over here, the starting point is the FEMA French model, and then we add a liquidity premium. LLQ is a given for a particular market. An estimate for the US market is 0.045 or 4.5%. So the question is, where do we come up with this number from? And the answer is right here. LLQ represents excess returns to a portfolio that invests the proceeds from shorting high liquidity stocks in a portfolio of low liquidity stocks. What this is saying is, all else equal, low liquidity stocks are going to give a higher return. investors will demand a higher return when they invest in low liquidity stocks. So the excess return on average for low liquidity stocks is 0.045, which means that if we take a stock with average liquidity, then the sensitivity of that stock is going to be 0. For a stock which is less liquid than average, there the beta liquidity is going to be positive, and for a stock that is more liquid than average, then the beta is going to be negative. Example 8 helps illustrate this particular point. We have a stock with the following characteristics, and based on this information, we are supposed to infer the style characteristic of the stock. The market beta is 1.5. This means that this particular stock is sensitive to market movements. This is the regular beta that we talk about. If the market moves by 1%, this particular stock is expected to move by 1.5%. Then the size beta is 0.15. Note that the size is positive, which means that this is a small cap stock. For a stock with average size, the size beta will be 0. If the size beta is positive, that means that the stock is smaller than average. Had the size beta been negative, as it was with Microsoft, that means that the stock is greater or larger than average. The stock has a value beta of minus 0.52. This means that this is a growth stock. Remember, for a value stock, we would have a positive value beta. And the liquidity beta is 0.2. This means that the liquidity of the stock is relatively low. Again, connecting with the previous slide, when the liquidity is low, then investors will demand a higher return. That's why we know that a positive liquidity beta must mean that the stock is relatively less liquid. So to summarize, this appears to be a small cap stock with a growth orientation, and the liquidity is relatively low. And this is what the curriculum has to say. Next, we come to macroeconomic multi-factor models. In macroeconomic factor models, the factors are economic variables that affect the expected future cash flows of companies and or the discount rate that is appropriate to determine their present values. Here is a specific example of a macroeconomic factor model. It is called the BIRR model, and these are the initials of the people who came up with the model. So notice that we are talking about economic variables over here. The required return is the T-bill rate plus sensitivity to confidence risk. Confidence risk refers to the unanticipated change in the return difference between risky corporate bonds and government bonds, both with maturities of 20 years. Then we have sensitivity to time horizon risk. This is the unanticipated change in the return difference between 20-year government bonds and 30-day treasury bills. Sensitivity to inflation risk. This is the unexpected change in the inflation rate. Nearly all stocks have negative exposure to this factor as their returns decline with positive inflation surprises. Sensitivity to business cycle risk. This is the unexpected change in the level of real business activity. A positive surprise or unanticipated change indicates that the expected growth rate of the economy measured in constant dollars has increased. And finally, sensitivity to market timing risk. The portion of the total return of an equity market proxy, such as the S&P 500 for the United States, that remains unexplained by the first four risk factors. Almost all stocks have positive sensitivity to this factor. And then we have these risk premia, which are calculated or determined using an econometric model, and these numbers will be specific to a given economy. Now, you do not need to understand all this material in detail. The curriculum doesn't spend much time on examples over here. If you get something like this on the exam, then chances are that you will be given a formula and you will simply have to plug numbers into the formula. So you might be given a particular stock and you would be told these sensitivities, and you would also be given these risk premia, and you would simply have to then calculate the required return. So don't worry too much about this. Just recognize that with macroeconomic multi-factor models, we come up with the required return based on macroeconomic variables. Next, we come to build-up models, and these are quite straightforward. Here we estimate the required return on an equity investment as the sum of the risk-free rate and a set of risk premiums. So we have the risk-free rate, the overall equity risk premium plus or minus one or more other premia or discounts. This is like the multi-factor model, but specific beta adjustments are not applied. So we just have the overall premium. We don't have the factor sensitivity multiplied by the factor. A classic example is one that you have also seen at level 1, where we come up with the cost of equity by taking the YTM on a given company's long-term debt and then adding a risk premium to the long-term debt. This can be viewed as a build-up model applying to companies with publicly traded debt, because this number is coming based on publicly traded debt. And then let's say a given company has a YTM of 7%. We can then say that the risk premium of owning equity in this particular company is 3%. So the overall cost of equity is 7% plus this build-up of 3%, which is 10%. Let us take a look at example 9 now. And I want you to read this first. The first question asks us to calculate the cost of equity using CAPM. We are given the equity risk premium, which is 4.5%. We are given the 20-year Treasury bond YTM of 5% and a beta of 1.72. So the required return is simply 5% plus 1.72 multiplied by 4.5, and you can do the calculation. Next, we are asked to calculate the cost of equity using the bond yield plus risk premium approach. With a risk premium of 3.5, what we have is this number, IBM's bond, which yields 5.63% plus 3.5%, which is approximately 9.1%. And note that there is a substantial difference between these two numbers. Then question 3 says, suppose that you found that IBM stock, which closed at 117.43, was slightly undervalued based on a DCF calculation using the CAPM cost of equity from 1. Does the alternative estimate of the cost of equity from question 2 support the conclusion based on question 1? So with 12.7%, we find the stock somewhat undervalued, which means that the intrinsic value we come up with using 12.7 is a little higher than 117. If we use a lower cost of equity, then we will come up with an intrinsic value that is even higher because we will be discounting at a lower rate. So the present value will be higher. So with 9.1%, we will conclude that IBM is even more undervalued. So here is what the curriculum says. This is the solution to 1, the CAPM approach. Then 9.1 is the solution using the bond yield plus premium approach. And this is the comment in response to question 3. Coming now to some international issues. When investing globally, investors are ultimately concerned about returns in their home currency. So if we have a United States-based investor investing in the UK, so the investment is denominated in pounds, ultimately the investor is concerned about returns in dollars. So when this particular asset denominated in pounds performs well, let's say that the asset goes up by 10%, that is not enough. The investor is also concerned about how the currency exchange rate has changed. If during the same period the pound depreciates by 10%, then effectively the investor has not made any money. So clearly, in addition to changes in the value of the asset, the investor is also concerned about changes in the dollar-pound exchange rate. The next point has to do with investing in emerging markets. Generally, it is difficult to arrive at required return and risk premium estimates for emerging markets. There are several approaches for coming up with the required return and risk premiums. We have talked about at least one approach in corporate finance at level 1. This particular reading describes two approaches which are actually somewhat simpler than what you saw at level 1. One approach is to use the country spread model, where we say that the equity risk premium is equal to the equity risk premium for a developed market plus a country premium. So if you have an American investor investing in Brazil, he will use the equity risk premium for the developed market, which would be the US market in this example, and then the investor would add a country premium based on the riskiness of investing in Brazil. The other approach is a little more complicated. Country risk rating models estimate equity risk premium using regression based on the empirical relationships between developed equity market returns and institutional investors' semi-annual risk rating for those markets. The estimated regression equation is then used with the risk rating for less developed markets to predict the required returns for those markets. So this is a regression-based approach. You do not need to get hung up with this. Just remember the fact that when investors from developed markets invest in developing markets, there is a certain risk premium that is added, and the models for coming up with that risk premium can vary from relatively simple to relatively complicated. Coming now to weighted average cost of capital, and this is something that you've seen several times before. Weighted average cost of capital is estimated as the after-tax weighted average required return of all suppliers of capital of a firm. This is the formula. Assuming simply debt and equity, this is the weightage for debt, the market value of debt divided by the total market value of debt and the total market value of equity, multiplied by the marginal cost of debt. Remember, all rates here are marginal. So marginal cost of debt means the cost of taking on more debt, 1 minus the marginal tax rate, and then this is the relative weight of equity, market value of equity divided by the total market weight of debt and equity, multiplied by the marginal cost of equity. At level 1, we also included preferred stock, but here we are making a simplistic assumption that there is no preferred stock. Weighted average cost of capital is the appropriate discount rate to use when discounting free cash flow to firm, because the free cash flow is available to all providers of capital, that is both equity holders and debt holders. Therefore, WACC is the appropriate discount rate. When we come up with the discounted value, this will be an estimate of the total value of the firm. So that will include both debt and equity. Here is a very simple example. I want you to try this before looking at the solution. And here is what you need to come up with. The cost of capital is the weight of debt, which is shown right here. And then the cost of debt shown over here, 1 minus the tax rate, and then the weight of equity, which is 1 minus 35%, into the cost of equity, which is actually 12.7%. When you do the calculation, you should get 9.65%. Discount rate selection in relation to cash flows. The point here is that we need to use an appropriate discount rate given the cash flows that we are discounting. The discount rates used for valuation should be consistent with the nature of cash flows being discounted. If cash flows are those available to all suppliers of capital to the firm, then the cost of capital should be used for discounting. And we talked about this on an earlier slide. If cash flows are those available to equity holders only, for example, if we are using FCFE, then the cost of equity should be used for discounting. When cash flows are in real terms, the discount rates should be in real terms. And we saw this in the corporate finance part of the curriculum. When cash flows are in nominal terms, then the discount rate should be in nominal terms. We are done with the reading. Let's look at a summary of the main points. You need to understand the distinction between realized versus expected holding period return. So if you are here at a particular time t, then the realized return is the return that you have realized, whereas the expected return is the return that you are expecting in the upcoming holding period. The holding period return is calculated as the sum of the dividend return and the capital gain return. Required return versus expected return. The required return is the return that we as investors require given the riskiness of an asset. In an efficient market, this will be the same as expected return. However, it is possible that the expected return is different from the required return if we have an inefficient market. Assuming that these two returns are different, then an investor will get a return which is made up of two parts. One part is the required return. The other part will be the return based on convergence of the price to intrinsic value. If we have an underpriced security, then the market price P will be below the intrinsic value. So what the investor hopes here is that the market price will catch up with the intrinsic value. This doesn't necessarily always happen though. Equity risk premium estimation using historical and forward-looking approaches. Equity risk premium is the difference between the market return and the risk-free rate. This difference can be calculated based on historical numbers, or it can be calculated using forward-looking approaches such as the dividend discount model. You need to recognize that there are different ways of estimating required return on equity. The most basic model, which we also saw at level 1, was the capital asset pricing model. Here at level 2, we have also learnt about the FEMA-French model, which adds additional factors such as a size related factor, as well as a factor that looks at the book value to market value. Then the Pastor-Stambo model takes the FEMA-French model and adds a factor for liquidity. We also looked at macroeconomic multi-factor models, which are based on macroeconomic variables, and build-up models where we do not consider betas. We simply take variables and add them. A really simple build-up model is where we take the YTM on the bond of a company and add a risk premium on top of that bond yield to come up with the required return on equity for a given company. Beta estimation for thinly traded and non-public companies. Here we talked about a 4-step process. What we do is identify a benchmark or a comparable company which is publicly traded, come up with the beta of that company. That beta will be an equity beta, so the beta then needs to be unlevered. And then we come to our target company, look at the leverage of the target company and lever up the beta based on the leverage of the target company. International considerations in required return estimation. Here, the two big items were related to the exchange rate. So as investors investing in other countries, we need to be very concerned about movements in exchange rates. As investors from developed countries investing in emerging markets, we need to be concerned about the risk premium associated with the emerging market. Weighted average cost of capital. This is simply the weight of debt into the cost of debt into 1 minus t, and the weight is based on market values. The cost of debt is a marginal cost. This is added to the weight of equity into cost of equity. Again, weight based on market values, and cost of equity is a marginal cost of equity. The weighted average cost of capital is the overall return or the average return demanded by the providers of capital. And this is the discount rate we use with free cash flow to firm. Cash flows and discount rates. Here we talked about the fact that we need to use the appropriate discount rate given the cash flows. So as we just said, if we have free cash flow to firm, then the appropriate discount rate is WACC. In situations where we have free cash flow to equity, then the appropriate discount rate will be the cost of equity. That is it for this reading.